Now we'll discuss about the ratio of total assets to debts. I think by now you can develop the formula yourself. Total assets to debt means total assets upon debts. This is the formula, and it establishes a relationship between total assets of the firm and debts. You know, in ratio analysis, debts means long-term debts, or you can say long-term loans. Basically, this ratio tells about the margin of safety, particularly for the lenders or bank. For example, I go to the bank for a loan of rupees 1 lakh. First of all, the bank will ask me how many assets you have got. Suppose I have got the assets of rupees 10 lakhs. Bank will be quite comfortable in giving loan to me. The reason being, if bank is not able to recover the loan, I mean to say I'm not able to pay off my loans in time, bank can sell my assets and recover its money. It means the bank has got sufficient margin of safety. So banks or lenders, they are always interested in this ratio. But one thing more I would like to tell you, when we talk about total assets in this firm, total assets means net assets. Net assets means after depreciation. For example, if some company has got total assets of rupees 5 lakhs and debts are rupees 1 lakh, it means the ratio is 5:1. So this high ratio is always better because it provides more margin of safety for the lenders. Suppose this is the balance sheet of a company. On liability side, capital 80,000, long-term loans 1,60,000, current liabilities 20,000. On asset sides, there are sundry assets 2,60,000. So in this way, the total is 2,60,000. And you are asked to calculate total assets to debts ratio. Means total assets upon debts. That means long term. So that will be 2,60,000 upon 1,60,000. That will be 26:16. Or I can say 13:8. Means 1.6:1. So this is the ratio of total assets to debts. Proprietary ratio. The formula of proprietary ratio is equity upon total assets into 100. It is always expressed in percentage. Naturally, the formula is telling you it establishes a relationship between equity and total assets. Means in the total assets, what is the percentage of equity? Equity means own funds, shareholders' funds. So I try to explain you with this example. Suppose A has got 100 rupees in his pocket, but B has got only 70 rupees in his pocket. But A tells you that he owes to his friends 60 rupees, but B says he owes only 10 rupees. It means out of 100, 60 belongs to other people, means this is the borrowed money. So actually he has got only 40 rupees. But so far this B is concerned, he has got 70 rupees in his pocket and he owes only rupees 10. It means actually he has got 60 rupees. Or in other words, I can say that out of the total assets, A has contributed 40% and B has contributed 85%. So in this way, B is better. Actually, this ratio tells you that in the total assets of the company, how much is the contribution of the owner. This is the main expression of this ratio. And this is never expressed in pure ratio, always in percentage. Suppose this is the balance sheet of a company or firm. Capital is 10,000 rupees. General reserve 5,000 rupees. Creditors 6,000 rupees. Long-term loans 9,000 rupees. So total 30,000 rupees. On asset side, building 20,000 rupees. Debtors 8,000 rupees. Profit and loss account 2,000 rupees. And the total 30,000 rupees. And you are asked to calculate proprietary ratio. Proprietary ratio means equity upon total assets into 100. So equity means shareholders' funds. That is capital plus accumulated profits minus accumulated losses, means 10,000 plus 5,000 minus 2,000 means 13,000. And in the way, the total of the asset is, that is only building and debtors, means 28,000. It means in this company, the equity is 13,000 and total assets are 28,000. So that will be equal to 1,300 upon 28, means 47%. So this ratio tells you that in this company, the owner contributes only 47% of the total assets. Higher ratio is always better.